This is one of the hardest things that's to get right as an investor. And that is because even if you did all of the research and you were correct on the opportunity and the stock was up 100%, you could have made a mistake doing this. And that is portfolio positioning. Stanley Druckenmiller has this great quote where he says, "It doesn't matter whether you are right or wrong. It matters how much money you make when you are right and how much money you lose when you are wrong." And that is absolutely correct. How much money you should put in an individual position is so critical to investing, but it's often kind of thought of as an afterthought. When you do all your research and you're thinking, yes, I should go ahead and buy this stock for XYZ reasons, I think it's very undervalued, the most important aspect of that is, how much did you buy? If you made it a 1% position, it may not really matter much to you. If you made it a 50% position, it may be the most impactful thing in your life. And so how you should think about positioning in a portfolio is very important. Now, I worked at Goldman Sachs and I worked at Capital Group, which managed trillions of dollars of equity. In fact, I helped direct billions of dollars of investment. And I currently am an investment advisor too. And one thing to keep in mind about diversification is it totally depends on your individual circumstance. If you are an investment fund and you have long-term money, you may want to concentrate your bets more because that is your best chance of actually outperforming. You want to put more money in your best ideas and less money in your worst ideas. It makes sense, except you need to keep in mind that things can happen that you didn't expect to happen. And you don't want to put yourself in a position that you're accepting risks that can ultimately put you out of business, or if you're an individual investor, wipe you out. Now, maybe you are very young and you have a small portfolio, and because of that, the kind of money you're adding to it every month, every year, makes what you currently have kind of trivial. Let's say you have a portfolio of $10,000 as an illustration, and you're saving $10,000 a year. You could put 50% in one stock, and in 2 years later, you know that that is only going to be 1/6 of your wealth, assuming, of course, the same valuation. And so that is something that people need to think about when they are diversifying. How much money I currently have relative to how much money I am adding to my portfolio and how much money I'm saving in every period. That is something that can allow you to potentially take a little bigger position than you would otherwise. The other thing to think about, though, is how comfortable you are holding these larger positions and with the risk in general. Of course, we all know stocks can move around, but having the experience of watching one of your stocks drop 50% is very different than hearing a story of it. If you've never been through it, you probably shouldn't be taking big positions until you understand how you feel about that. And that is because what is going to happen is when you are in that situation, you might freak out basically. That's just the case for a lot of people, especially if it's money that you need, which you should not be, by the way, using to invest. Your investment money should be discretionary money that you do not rely on for sort of day-to-day living. But either way, you should understand how you're going to react to that sort of drawdown before you put more money in it. Because a lot of times people think that, yeah, I could handle a 50% drop. And what ends up happening is when the 50% drop happens, it influences their logic of why they bought that stock in the first place. They start second guessing themselves. They start thinking maybe my research was wrong. They start listening to other people, the bears on the stock, more than they were before. And so one example is, let's take a look at Meta. A lot of the risks with Meta were kind of, well known for some period of time, yet the stock still dropped from $360 to a low of about $90. I can tell you from firsthand experience, when it was at $90, everyone thought they were done as a business. And it was very hard as a shareholder of that stock. And I wrote, a 120 plus page research report on that at the beginning of 2023. And so everything, my thoughts and all that are marked out in there. It was kind of a scary time still to hold it. And I won't get into all the details of what was going on with the business at the time. But what you need to understand is that it didn't exactly go down for no reason. There were sort of new headwinds happening at the time. Time spent wasn't growing anymore because of TikTok. You had app tracking transparency, which was cutting off a lot of the data they used to track ads. You had them spending so much more money in CapEx to try to repair the signal, and it wasn't clear if that was going to work yet or not. You also had the antitrust case that was kind of, even if you thought it wasn't going to go anywhere, it was definitely distracting them. You saw North American users for Facebook was dropping amongst young people, and you saw impressions, their ability to show ads was dropping too. And so those were all real things things that were impacting their business. And it came alongside this huge drawdown in the stock price. And so if you made it a big position initially, two things would have happened. One, you would have been down a lot more, which would have been kind of harder to hold. But second, you would have had less money to add to that position. And so what I do and think makes the most sense is you think about at a maximum, what percent of my portfolio do I want to invest in this one stock? Then what you do is you think at what price would you want to hit your max sort of investment. And so in the case of Facebook, just throwing numbers out there, let's say you said, I don't want to put more than 15% in one stock, and that is the absolute max I will go. Okay, well, at what price is that 15% going to be? Let's say we're rewinding to 2022 when Facebook was still $300 a share. You may say, okay, well, it's not that cheap right now. Maybe I'll take a 3-4% position. I'm just throwing an illustration out here. But if it gets to $200, I'll take a 6%. If it gets to 180, I'll go 8%. If it gets to $100, I'll go the full 15% position. And if it drops below $100, I'm not going to add anything else. That's already my full position. And so you do kind of have to make that decision ahead of time, but having that game plan and that sort of clarity is going to allow you to act when these things actually happen and follow the sort of plan. Of course, though, and this is why it's so tricky, stocks usually don't fall that much for no reason. And as I mentioned, things were changing with the business. There were these new risks that were starting to form. Now, ultimately, if you did the research like we did in our big research report, which, by the way, if you want to become a member of that, you can go to speedwellresearch.com, it's called. That's my research company where I write about investing, stocks, and all that. To be honest, it is more for professional investors, asset managers. But if you are curious in that, you can go to the website and check out that service. It's called speedwellresearch.com. There's always a link in the show notes to it as well. But my point there is that I did this research. I did an insane amount of research. I read every single earnings call transcript. I wanted to understand how Mark Zuckerberg thought. I read every single biography that existed on him. I read all the conference calls. I read a lot on ad tech. I talked to people in the industry to try to understand how advertising technology worked, whether or not they would be able to repair the signal. And it got kind of complicated. I had to learn about something called CAPI and Advantage Plus and all these new things and tools. And that was what was necessary in order to kind of, at least for me, have confidence holding through that time. Now, if it was a huger position, it just would have been all the more harder. Would have been harder again because I couldn't have added more at a cheaper price. And also just emotionally, don't overlook the emotional aspect. A lot of us who do invest, we're very logical, left brain, even though Ian McGilchrist would say it's not the left brain. That's a different sort of topic there. And you tend to overlook the emotional toll it can take, not just on your day-to-day, but actually on your logic. Once again, if you are down 50%, I promise you are not thinking you are correct in your analysis. It's a lot harder to sort of hold that position. And until you live through it, you should probably be a little bit more conservative. Now, the other factor you should sort of think about is that when you are investing is the timeline of your investments. When you invest money, you're playing two roles. You're an investment manager, but you're also your own financial advisor in a way. Because as a financial advisor, you're supposed to know what money you can direct to long-term investments and what money to direct to short-term investments. Now, it's kind of common, though, that people commingle these two, and it leads to really bad results because all of a sudden you have a portfolio that maybe was invested in a bunch of tech stocks in 2022, good stocks long-term, except they're down a bunch right now. And now you need money to pay a college tuition, private school, a mortgage down payment, whatever it is. And you're kind of stuck now selling at these reduced rates. And it's also just adding more pressure to you. Not only is it really bad because you're selling stock that is depressed and you didn't have any sort of emergency savings. That is why when you're investing, you need to think about the time duration of what you're investing in and when your own personal capital needs are going to be. And I'm going to talk a little bit more about that, kind of the personal finance stuff, a little bit more in future videos. But it may seem like a lot of people, oh, I'm just going to make money and I just want to invest. I've seen, that's a big issue though, because if you don't have it planned out properly, how much money you expect to spend, you're going to be dipping into that investment account and it's going to stress you out and it's going to lead to worse investment decisions. It's going to make you a forced seller. In fact, hedge funds, they gate the money that can go into the hedge fund exactly because they do not want to be a forced seller in a bad time. You are basically doing that to yourself if you never did the financial planning and the investment advisory aspect of that. And so those are a few things to keep in mind when you are making a position in it. The size of that position should correlate to your confidence in that position, as well as the upside in that position and how much you are potentially willing to lose. But again, don't underestimate the aspect of emotions and psychological biases that can influence your investing. And so to better understand how all this plays out in the decisions you make, which is key to become a good investor over time, check out this video here. And if you enjoyed this and you want to learn more about investing and how to become a better investor, go ahead and hit subscribe.